we all want to know the future.
Right.
It's the oldest human obsession. We want the cheat codes.
Mm-hmm.
We want to know who wins the election, when a war might end, or, even if aliens are finally going to show up.
Which is usually nothing. Usually those predictions are worth absolutely nothing.
Yeah, exactly. But today, we're looking at a machine that actually puts a price tag on the future. We're doing a deep dive into Polymarket.
Mm-hmm.
And I know you're thinking, oh, great, another crypto thing. But this one,
mm-hmm.
it's actually broken out of that bubble. We're seeing major outlets like the Wall Street Journal, the New York Times, citing this platform's odds right alongside their own polls.
It's become a genuine cultural phenomenon. And what's so interesting to me is that on the surface, it looks exactly like a degenerate gambling site.
It does.
It looks like a casino, but if you actually pop the hood, which is what we're doing today, it's designed to be a truth-seeking engine.
Okay, hold on. I have to push back on that immediately. Truth-seeking engine sounds very noble, but if I log onto the site, I see people betting on whether Taylor Swift gets engaged. How is that different from me walking into a sports book in Vegas and putting money on the Super Bowl?
It feels the same, I get that. But the mechanics are. They're just fundamentally different. Think about a casino. You are playing against the house.
And the house always wins.
Because the house sets the odds. They have an algorithm or some centralized expert who decides the price to make sure they make a profit. But in a prediction market like Polymarket, there is no house.
So it's peer-to-peer.
Exactly. The users set the odds.
So if I want to bet yes on something, I have to find someone on the other side willing to bet no.
Precisely. You're buying and selling shares of a future event, and the brilliance is in the simplicity. Every single share pays out exactly $1 if you're right and 0 if you're not.
So it's binary, all or nothing.
Right. And because that payout is locked at $1, the price of the share becomes a perfect percentage. If a share costs, say, 60 cents, the market is basically screaming that there's a 60% probability of that event happening.
Okay, but why is that truth? If a bunch of random people on the internet decide something is 60% likely, isn't that just mob mentality? Why is that better than asking, a PhD in political science?
So this takes us all the way back to Friedrich Hayek, the economist. In 1945, he wrote this seminal paper on the use of knowledge in society. And his whole argument was that knowledge isn't concentrated in the heads of a few experts.
Right.
It's dispersed. It's scattered across millions of people.
The classic example is the shopkeeper knows more about the local economy than the central banker in some far-off capital.
Precisely. Hayek argued that markets are the only way to aggregate all that tiny scattered information. But Polymarket adds the secret ingredient: skin in the game. Money. On Twitter, you can say, oh, I think this candidate will win by a landslide, and it costs you nothing to be wrong.
Right.
You get clout if you're right, and you just delete the tweet if you're wrong. But here, you have to pay to have an opinion. That financial risk. It filters out all the noise. It strips away the wishful thinking.
So it forces honesty.
Yeah.
You might want your team to win the championship, but you're not going to bet your mortgage on them unless you really, truly believe they're going to win.
That's the theory. When money is on the line, the bullshit walks.
But is this actually a new idea? I mean, it feels like humans have been betting on outcomes since we lived in caves.
Oh, the tech is new, but the behavior is ancient. In the 16th century, there were these massive betting markets on who the next pope would be.
Betting on the Pope. Seriously. That feels, I don't know, a little sacrilegious.
The Vatican definitely thought so. They eventually banned it. But it just kept evolving. In London, in the 1700s, you had Jonathan's Coffee House. This was basically the Twitter of its day, but with cash.
Wow.
People would trade rumors about wars and politics and back them up with actual coin. It was the precursor to the London Stock Exchange.
So the stock market basically started as a bunch of guys in a coffee shop betting on rumors. That's incredible.
Pretty much. And here in the U.S., up until the mid-20th century, betting on presidential elections was huge. Candidates would publicly bet on themselves just to show confidence.
No way.
Yeah, it was a standard part of the whole political process until strict gambling regulations shut it all down.
So we killed the market, and now crypto has brought it back.
Yeah.
But why did Polymarket succeed? I remember hearing about a project called Augur back in 2018. That was supposed to be the big thing.
Augur was the right idea at the wrong time with totally the wrong execution. It was built on Ethereum when Ethereum was incredibly slow and expensive.
Right.
So placing a $10 bet might cost you $50 in transaction fees. Plus, the interface, it was built for computer scientists, not for normal people.
So it was just a ghost town. No one was using it.
Exactly. And liquidity is everything in these markets. If there's no one there to take the other side of your bet, the market just dies. Polymarket fixed the user experience. It looks like a news site. It uses USDC, so you aren't worrying about the price of Bitcoin going up and down, just the dollar value. And it's fast. They lowered the barrier to entry enough that regular people and big money could actually show up.
And show if they did.
Yeah.
We have to talk about the French whale.
Yeah.
This was the defining story of the 2024 election. While the rest of the world was looking at polling data that said, yeah, it's a coin flip, this one guy was painting a totally different picture.
This is the perfect case study for why these markets work. This trader, known only as Theo, bet roughly $70 million on Donald Trump to win.
$70 million. I mean, I don't care who you are. That is a terrifying amount of money to put on a hunch.
But that's the key. It wasn't a hunch. Theo didn't trust the mainstream polls. He thought they were structurally broken.
Okay.
He believed that there was a shy voter effect, that the polls were completely missing people who wouldn't admit to a pollster that they were voting for Trump, but would absolutely pull that lever in the voting booth.
But everyone talks about the shy voter effect. That's not a new idea. How did he prove it?
He commissioned his own private polling, but he used something called the neighbor method.
The neighbor method. Okay, walk me through this. How does asking about a neighbor fix the data?
It's a brilliant psychological hack. If I ask you, who are you voting for? You might lie because you want to look virtuous, or you're afraid I'll judge you. It's called social desirability bias.
Right.
But if I ask you, who do you think your neighbor is voting for? You drop the ego. You just answer honestly based on what you see, the yard signs, the bumper stickers, the conversations you overhear.
You become a neutral observer of your environment.
Exactly. Thea's data showed that while people were non-committal about themselves, they were convinced their neighbors were all voting for Trump. He saw that discrepancy, realized the market was mispricing the odds, and he went all in.
But if you drop $70 million into a market, you make a splash. You move the odds. Everyone sees the whale coming.
And he tried to be subtle. He used 11 different anonymous accounts to drip feed the bets. But on a public blockchain, you can't hide forever. Online sleuths started linking the accounts, realizing they were all funded from the same place. By then, though, the signal was out. The market shifted toward Trump long before the votes were ever counted.
And he walked away with, what was the final number?
About $80 million in profit, roughly a $150 million total payout.
Wow. That is the ultimate I told you so.
It totally validates the Hayek theory. A motivated individual with better data corrected the entire market. The polls were free and they were wrong. The market was expensive and it was right.
Okay, so that's the high-minded geopolitical side of things. But looking through the source material, there is some absolutely bizarre stuff on this platform. It's not just elections.
Oh, not at all. It acts as a news aggregator for everything. There are markets for, will Bitcoin hit 150K? Will Taylor Swift break up with her boyfriend? Or, my personal favorite, will Jesus return to Earth in 2025?
I saw that. And I mean, first of all, how do you verify that? Does Jesus have to hold a press conference? But secondly, who on earth is betting on this?
People are, but the financial mechanics of that specific bet are actually a fascinating lesson in economics.
Please don't tell me there's a smart way to bet on the apocalypse.
There is. Think about it. The no shares betting that Jesus won't return, they trade at roughly 96 or 97 cents.
Okay, so it's almost a sure thing.
Right. If you buy that share, you are locking in a 3 or 4% annualized return on your money.
Which is basically the same as buying a U.S. Treasury bond.
Exactly. So the market is effectively treating the continued absence of Jesus as a risk-free asset on par with U.S. government debt. It's an arbitrage on theological risk.
That is hilarious. So I can either lend my money to the U.S. government or I can bet against the second coming, and the yield is about the same.
And hey, if you're wrong and Jesus does return, losing your dollar is probably the least of your concerns at that point.
Fair point. If the sky rips open, I am not checking my portfolio.
But you mentioned arbitrage, and the sources say this is where the robots come in.
Yes. We focus on the big human stories, but a huge portion of the volume on Polymarket is just automated. Remember how we said yes plus no must always equal $1?
Right. 60 cents plus 40 cents.
Well, sometimes, because of market volatility, yes might be 61 cents and no might be 41 cents. That adds up to $1.02. It's a mass error.
And the bots just spot it instantly.
Instantly, they buy the inefficiency and lock in a guaranteed risk-free profit. It's estimated these bots are making around $40 million a year just sweeping up these pennies. They're like the janitors of the prediction market, keeping the math honest.
That's wild. Okay, but let's pivot to the dark side here. Because so far, we've painted this picture of a perfect, truth-seeking machine, but there are cracks in the system. And the biggest one seems to be, who decides who actually won?
The Oracle problem.
Right. The outline calls this Zelensky's suit. This is a classic example. A market asked a very simple question. Will President Zelensky wear a suit to this specific event?
Okay, sounds simple. Did he wear a suit or not?
Wow. He showed up wearing a matching jacket and trousers. But it wasn't a tuxedo, and it wasn't your typical business suit. It was formal, but it was distinct. So, did he wear a suit?
That's completely subjective.
Yeah.
I might say yes, you might say no.
And millions of dollars were hanging on that definition. Now, in a decentralized system, there's no CEO of Polymarket to call and ask. They use a system called UMA. Basically, token holders vote on the outcome. It's a democratic jury.
Right, democratic truth.
But here's the flaw. It's a plutocracy, not a democracy. One token equals one vote. So if there's a massive market, say $50 million is at stake, and it costs me $5 million to buy enough tokens to swing the vote.
You spend the $5 million to win the $50 million.
Exactly. It's a 51% attack on the truth. The sources mention a case where a whale allegedly did exactly this. They had enough money to just bribe the jury, effectively making their version of reality the true one.
So reality just goes to the highest bidder. That is terrifying if we start using this for things that actually matter.
It creates a crisis of confidence. If you can't trust the judge, you won't play the game. But there's a risk that's even more dangerous than a rigged jury.
Reflexivity.
Reflexivity.
This is the George Soros concept, right?
Yes. The fundamental question is, does the market just predict the event? Or can the market actually cause the event?
Give me a concrete example.
Okay, imagine a political candidate is falling behind in the polls. They're desperate. A wealthy donor, or maybe even a foreign government, pumps $20 million into Polymarket, betting on that candidate to win.
So the odds spike. They go way up.
But the odds spike. The news picks it up. Candidate X surges in prediction markets. Suddenly, other donors start writing checks again. Voters think, oh, wow, maybe he can actually win. The momentum shifts. The bet didn't predict the surge. The bet manufactured the surge.
Becomes a self-fulfilling prophecy.
Yeah.
We're basically just buying the narrative.
And we saw accusations of this with someone like Elon Musk, suggesting his tweets or his influence might be shifting odds on purpose. Whether it's true or not, the mechanism exists. You can turn the prediction market into a marketing channel.
And then there's the other side of that insider info, the war markets. This part of the research really crept me out.
It should. There are markets asking, will Israel bomb Iran before Friday, or will Ukraine strike this specific bridge?
And people are betting real money on this.
Not just people. The patterns strongly suggest insiders. You'll see these fresh crypto wallets funded an hour ago dropping $100,000 on yes right before an airstrike actually happened.
It's effectively an intelligence leak.
It is. If you work at the Pentagon or the Mossad, you have information that is worth millions of dollars on Polymarket. It turns the platform into a leak machine. If the odds of an invasion suddenly spike to 90% out of nowhere, you don't need a CIA briefing to know what's about to happen. The money knows first.
That gives me chills. It's like the market is omniscient, but for all the wrong reasons.
It forces us to confront the morality of it all. We're commodifying disaster. We're putting a bounty on outcomes.
Which leads to the darkest thought of all, doesn't it?
Yeah.
If you follow this logic to its absolute end, if you can bet on literally anything.
You eventually get to assassination markets.
Meaning, I bet that a specific person dies on a certain date.
And by placing that bet, you create a pot of money, a reward for anyone who makes it happen. If the market for will this person die in 2026 hits $10 million, that is essentially a crowdsourced hit.
And suddenly, prediction markets aren't just observing the world, they're actively shaping the absolute worst parts of it.
It is the ultimate double-edged sword. We have built a tool that can harness the wisdom of crowds to outsmart experts in polls. It's efficient, it's powerful, and it can be brutally honest. But a tool that powerful, it doesn't care about ethics, it just cares about the payout.
Wow, it's a lot to process. We started with fun gambling app and ended up at crowdsourced hitmen.
That is the nature of the deep dive.
Well, on that cheerful note, we should probably wrap up. Just a quick reminder to everyone listening, this deep dive is for educational purposes only. We are not financial advisors. And please, don't go betting your life savings on whether aliens are going to land next Tuesday.
Although, if the odds